All right, let's take a look at the stock market again. So if you think about this logically, um, there is no big institutional money that is going to come into the market as long as the Fed keeps telegraphing more and more interest rate hikes. They're trying to bring down commodity inflation, and obviously that's going to bring down the stock market with it, and probably create a recession. And so by big money, I mean funds that are controlling multi-billions of dollars. It's not easy for them to get in the market, and it's not easy for them to get out of the market. It takes time for that kind of money to move, either in or out. And so that kind of big money is what you need to put in a final bottom. And that kind of money is not going to be coming into the market until the Fed reverses policy. So, I see people coming up with all kinds of reasons for why the stock market's going to rally, or why, we've got some historical precedent that suggests that we're at or just about at the end of this bear market. And I just don't think any of that is valid until we have the conditions where big money feels confident to start entering the market for long-term positions that they can hold for many months and probably multiple years. And as long as the Fed continues to telegraph that they're going to hike rates, that's just not going to happen. So I think it's futile to try and find some reason for why the stock market is going to rally. Now, all that being said, a little common sense will tell you that the Fed may want to bring down stocks, and they may even want to create a recession. I think they're probably foolish enough to think that they can do this without creating a recession, but they're not. They're gonna mess it up like they always do. So, but the one thing the Fed doesn't want is a major stock market crash. They would prefer that this continue to step down gradually over the next 6 months to a year and a half. However, I think there's risk here that they're gonna lose control of this and cause a crash. So let me point out a couple of levels here. We've got a support zone right in here, and it kind of corresponds with this bottom. And once this support zone is broken, then there is risk that the market could just drop down to the next real support zone here, which is about, let's just call it 3,200. And if this were to start to crash and really accelerate violently lower, we might just go right through that support zone, and then at that point there's really nothing but air until you get down to the March 2020 bottom. And that's the problem with this QE driven rally here, is that there really isn't a lot of support zones along the way. This was kind of just a straight up shot. And really the only support in this whole chart is right here. We're breaking that right now, and then right in here. So there's a lot of risk. So we're going to continue to get these interventions like this. This is not natural. Like I said, there's no big money that's coming into this market anticipating a bottom right now. So these are not natural rallies. These are interventions to try and slow the decline and prevent the market from crashing. And they're not holding. This was a intervention to get the market going up ahead of Jackson Hole. That didn't hold. We had another intervention here right on this trend line. Let me see if I can draw that in, show you this. And I warned people this was coming. All right, so here's this trend line. Daily cycle lows should break that trend line before they bottom. So this was not a natural rally either. This was an attempt to stop this crash that was developing, and it lasted for about 4 days, and then it gave up the ghost. We come down, and now we're into this critical support zone. So there's going to be a lot of attempts to stop this decline at this support zone. But again, there's not going to be any natural buying here, and not until the Fed reverses policy. So there's no big money coming in here. So these aren't natural rallies. These are interventions to try and prevent the market from crashing. I think the Fed is probably okay with a slow stair-step down bear market, but they are not going to be okay with something that looks like a 1987 crash. And that's what this was as well. We were the market was threatening to break through the downside of this support zone. So we had another major intervention on Thursday, but then again, there's no follow through, which is a pretty good indication that this is not a natural rally. If this was a natural rally, there would either be some follow through or at the very least a flat day, but there wasn't. The selling just came right back in, and now we've kind of closed below this support zone again. So the market is at risk. Let me widen this chart. The market is at risk of dropping down to this next support zone here, and it could do it fairly rapidly. The potential trigger event that could give us a more lasting bottom might be the midterms. If the conservatives retake the House and the Senate, then we'd be in deadlock, which I think the market would like deadlock. I think the market would prefer that the government just quit screwing things up, and if we can get the government deadlocked, then their ability to mess things up is severely constrained. I think the market would like that, and so that is the potential trigger event, is the elections in early November, and in my opinion, that's probably the most likely spot where we could get our next real bear market rally, not just some intervention that's trying to stop this market from a full-on crash. So it just doesn't look like this support zone is going to hold, no matter how many interventions the government and the Fed throw in here. They're just not lasting. So I'm sure there are going to be more, but it's not looking promising here. It looks like this support zone is probably going to break, no matter the best efforts by the government and the Fed to keep this market propped up and to stop the crash. And then, as I said, the next support zone is right here. Now let me switch over to the Nasdaq, because we got kind of a big problem. The support zone for the S&P is right here, but for the Nasdaq, let me switch this chart. All right, so this is the Nasdaq, and for the Nasdaq, we've got a problem here in that the Nasdaq is already breaking through this support zone. It already traded through this level here, came down. We had our rescue attempt on Thursday, and now the Nasdaq has given that back, and it's holding below this support zone. So it doesn't look like any of these attempts to artificially prop the market up are going to succeed. And if the Nasdaq really starts to get some momentum lower, then I think there is real risk that the S&P could just trade right through that support zone at 3,200, and the possibility that we really could get a serious out of control crash type event. And that would force the Fed to change policy. They would have to start cutting rates again. They would have to reinstitute QE, and that might have the potential, I stress the word might have the potential to give us an slightly early 3-year cycle low in the commodity complex and a slightly early 8-year cycle low in gold. So not a very high odds of that, but a slight chance. And for it to happen at all, I think we've got to have that major crash event, something that looks like 1987. So anyway, markets are at risk here. The interventions don't appear to be working. I don't think they're going to work. So I don't think you want to be long. And I think it's going to be difficult to be short, because we're going to continue to see these interventions that are trying to stop this. And, in real time, you just don't know whether one of them might do it or not. But But so far, it doesn't look promising that the Fed or the plunge protection team are going to be able to stop this market, and the risk of a crash is becoming larger and larger as time goes on.